Are you diversified? Welcome to Investing Mastermind Podcast. My name is Sina Lundholt.
And I'm Michelle Markey.
Today, the episode is about diversification. It's a very interesting topic because if you are buying stocks in the stock market, you've heard about the importance of being diversified. It's something that's being thrown around all over. It's the most important thing you can do, at least on many blogs, social media, articles, says be diversified. However, Warren Buffett, his investing style is different. It's about being highly specialized in something, which make it really difficult to be diversified. And in the very beginning of his career, he only owned a few companies, not 10 or 20, but just a small handful that he was very focused on. And he was very focused on the quality of those companies and that they were low risk rather than being diversified. And what I mean by low risk is that when you study a company, when you do all the due diligence needed to get to understand the management, to understand the business model, etc., then you know a lot about that business and whether or not it's a healthy business or a sickly business. And of course, we want to invest in quality. We want to invest in healthy businesses. And if you need to study 20 businesses in detail, that can be very difficult. Study 20 businesses in order to feel diversified instead of finding one business that you study in detail and learn everything about it. So this topic here that we're going to discuss today is very controversial and it goes against the norm. Charlie Munger calls it diversification, like it gets worse, diversification.
I know it's a mouthful to say because it almost sounds like the real thing, like diversification, but emphasis on diversification, like how
it's my
Peter
European
Lynch
again.
also says that. It's okay. But yeah, so the point they're making is that contrary to popular investment advice, is that you really shouldn't necessarily be that diversified if you know what you're doing. So what Charlie Munger has said is diversification is for a know-nothing investor. Like if you don't know what you're doing and you have not much choice but to invest in an S&P 500 index fund with 500 companies, then that's maybe one of the better things you could do is go that route. If you're not going to either take the time to learn about investing or you don't have the wherewithal, like some people just aren't cut out for this sort of mental math exercise of looking into companies and looking at balance sheets and trying to do some math. Maybe it's not your thing and it's okay. There's no shame in being a know-nothing investor, but just be aware of the fact that diversification is kind of not the friend of someone who wants to be highly concentrated in the few companies they believe in and the stocks that they have studied closely so that they invest in, say, maybe somewhere between 5 to 10 or up to 20 stocks, because that kind of goes to what Warren Buffett has said. Imagine if over the course of a lifetime, you have a punch card where you can only get 20 hole punches in a card. You know how we might get a little freebie, like after the 10th burrito you buy, you get the 11th burrito for free. You know, things like that you can find at some stores, some shops. But in the case of investing, think of if you could only invest in up to 20 companies over your entire lifetime of living for 100 years, that's all you can do. So that's not a lot of companies that you get to invest in over your lifetime if you're going about it the Warren Buffett style. It doesn't mean you have to, but you'd go about it in a little bit of a different way.
I also think that a lot of people, they think they're diversified in their portfolio, but they really aren't. And a couple of episodes ago, I talked about a lesson I had about being diversified, where I thought I was diversified. I had, helped out some small businesses in Africa by, issuing out loans, microloans to some business owners. And it turned out there was somebody embezzling and that whole company collapsed because of it. So when I did those microloans, I was looking into a range of different kinds of businesses, delis, hair salons, tailors, agriculture, all sorts of different female entrepreneurs in Africa that I could support in many, many different African countries. And I really thought that I was doing my best to be diversified. What I learned is that I need to take diversification much more seriously. It needs to be multiple asset classes, multiple continents, not just one continent like Africa, but multiple different continents in order to actually be feeling diversified. Now, I also like the thought of being concentrated, and I'm early on in my investing career, but over time, if I need to be diversified, I need to go beyond stocks and beyond the regions I'm investing stocks in. And there might be cultures I don't understand, so I wouldn't necessarily do anything there. But, we've all seen how a crisis in America becomes a global crisis. So being diversified means that, you can't even only hold assets in Europe and America because Europe relies so much on the United States. So if anything happens in the US, and we saw that multiple times during the 2000 crash as well as 2008, how, it spilled over into the European markets. So yeah, it's like a domino effect when something like that happens. And that's why diversification needs to be very broad in order for you to not momentarily lose money.
Yeah. And we might be throwing at you some concepts that might sound a little bit confusing at first, because we're saying both like Warren Buffett style investors aren't too diversified, but then they're diversified across different asset classes and countries. So what we want to say with that is, for example, Charlie Munger thinks you're diversified enough if in a little town that you own a car dealership, a McDonald's, and an apartment building. These are different kinds of assets. Like, they are different business models, so that no matter what the local economy is doing, you're plenty diversified. If you were to just be in America in a little town and you control these businesses, that's plenty of diversification. And let's say the fourth thing is you own some stocks in publicly traded companies. So that would be nice. And then to Sina's point, if you don't want to have all your eggs in an American basket, maybe you invest in South America or Europe or Asia. There could be plenty of opportunities abroad, especially if something like the American stock market is too overvalued. Even now, it could still be a little bit frothy in American markets. So if America is too crowded of a game, you don't have to play the game here. You can go to other countries and other places where there could be better opportunities. As a lot of respected investors like Jeremy Grantham have said, the chances for emerging markets to perform better over the next 7 years is significant compared to the US, where markets are still a little bit expensive. So, if you want to have some diversification across different assets, you can do that, but still not go too crazy. It's not like you say, okay, I'm going to invest in the MSCI World Index that's invested in hundreds or thousands of companies. I don't even know, but that's not necessarily what we're trying to encourage with diversification across assets and countries. You're still trying to be very specifically invested in a certain company. So let's say, just as an example, you don't have to do this, but it's just a hypothetical for educational purposes only. Let's say you're from the US and you feel the most comfortable with American stocks. So maybe you invest in 5 to 10 American stocks, and then you might find one in South America, and maybe you invest in that one company, but you don't invest too much. You invest only that what you're comfortable with whatever few percentage points in your portfolio. And then you might find another stock in Asia and you invest a few percent in that one, maybe. So that's what we're talking about, where you want to be somewhat diversified like that. You don't want to put all your eggs in the American basket, but not go too crazy and not just invest in all of the index funds and all of the mutual funds. And another form of diversification is in different types of assets. So there's not only stocks, but bonds and real estate, and your own business is a way to diversify. So having multiple income streams that are not codependent on each other. So you want to have what Nassim Nicholas Taleb would call an anti-fragile portfolio, by making sure that things are not too dependent on each other. So if the American economy is having a crisis, that will not affect maybe your business based in Europe, because it may not be correlated. They may be separate enough that no matter what's going on in America, you can still earn money in Europe without it having, and it like has nothing to do with the American economy, let's say.
Yeah, and you just have to be patient. You don't need to build a portfolio of different asset classes right now. It potentially will take years for you to do. Just take it easy, one step at a time. Don't rush it. And, when we're talking about bonds and real estate and stocks, it will take some time to really learn about each of these topics. So it is inevitably going to take a very, very long time for you if you want a truly diversified portfolio of assets. And also note that we're not talking about gold, silver, art, diamonds, because we believe that those things does not have an intrinsic value like a business or a stock has some value to it, if the company has certain value inside. And you can't say that about art or wine. It's more, what does people like that year that will determine the price of that. So it's a bit more, risky to invest in or to trade assets like that.
And it's because things like art are subjective, and in and of itself, it doesn't produce cash flow, unlike a business. So Warren Buffett even said, if you offered me all the crypto in the world, I wouldn't even pay $25 for it, because it doesn't do anything by itself. In fact, crypto actually consumes energy. So it kind of costs money to kind of do things with crypto in some ways. So it's sort of ironic how, unlike a business, which is giving you cash, a lot of how some crypto is structured is using up energy. So someone kind of has to pay for that. And a lot of crypto out there relies on the greater fool theory, where you just hope the next fool is willing to pay more for it than you did. And that's not what a legitimate business does in producing cash flow, because a business that people value, that people appreciate, is like giving you a valuable service that you need, that you worked in some way, like whether through your own business or by working for a company, you earned income, and you use your income to pay for another service or a good. So, let's say someone's walking a dog because you are away on vacation. You will gladly pay that person who's walking your dog money, because they're giving you a valuable service. Otherwise, your dog would die at home if they don't get to go out, stretch their legs, and don't get fed and don't get water. You are willing to pay for that service. It's valuable to you. So that dog walker has a good, valuable, cash producing business that's important.
Yeah, and thank you so much for explaining what I meant in detail. I really appreciate it. I want to touch upon what you also mentioned about the global index, because in my opinion, it's also an illusion to believe that because you're buying an ETF, you are automatically diversified. You might not be. And I've had a client who owned multiple different ETFs, and I took a look at the fact sheets of these ETFs, and it turned out that many of these, so an ETF is a holding of multiple stocks. You can compare it to a shopping cart, and in that shopping cart, you will have many different kinds of stocks. There's ice cream and strawberries and also detergent, all kinds of things in that package. And she had multiple of these ETFs. There's so many ETFs out there. When I looked at the fact sheet of these ETFs, it turned out that many of these stocks that were in these packages were the same. There were major overlaps, like Apple, for example, and some of the S&P 500 companies were in multiple of these ETFs. And she thought she was diversified because that's what she heard, that you need to, spread your investments, and ETFs is a good way to do that. But as a beginner investor, it's, you might not know about these fact sheets where you can read what's actually in here, but it's so important to know what you're doing. And like Michelle says, there's nothing wrong in buying an ETF if you're not the type of investor we are, and you need to buy an ETF. Do it. Make sure to read the fact sheet. It's readily accessible online. from the company that created this basket of stocks, and you can read it and learn more about which stocks are in here, so you don't go out and then buy the same thing. Like, even, it's so funny with Apple, because it was in ETFs that were supposed to be for emerging countries. The reason why that fund decided that Apple needed to be in there was because Apple is such a growth stock, and they were certain to see some kind of growth in that emerging market when they put Apple in there. So I believe that's why. Of course, I don't know why Apple would be in an emerging market fund, but my thought is they needed to be sure of some growth.
Yeah, instead of like just putting a bunch of mediocre random companies, they were like, let's put this large cap that's sure to win. It just like kind of just goes to show you that like people don't always really know what they're actually invested in. And by reading the prospectus of funds, you can gain a better idea of sort of what's in it. You don't always entirely still know, and it will take forever probably to research every single thing in there, even if you did know what's exactly in the fund. So it makes me feel uncomfortable not being sure to know what I'm invested in. If it's just like a bunch of things, you might be invested in something that doesn't agree with your moral and ethical values. And there's so much of that out there. So
most likely, if you buy an ETF, there's going to be guns, or I mean, maybe you like to invest in that. I can't, but there's 100% going to be something in there that you definitely don't want, if it's chemicals or warfare or something that you just don't agree with. Yeah,
or maybe
guaranteed.
some people don't agree with Disney lately, and Disney might be part of some index fund. So even though Disney was supposed to be this feel good, family friendly like company,
good, clean family entertainment you can trust.
and yet it's been getting into some political hot water. So some people might not want to be invested in Disney right now. I don't know. Not saying people should or shouldn't, but there's all kinds of things that could be in a fund that maybe you don't like for some reason. It's sort of like that, and you got to be a little bit mindful. And sometimes, unfortunately, we don't always have choice. Like in a 401k, an employer might offer up only like a few dozen fund options, or your other alternative is to just be in the cash fund or the guaranteed fund, whatever it is. But it's kind of like annoying, because I wish that we could more so invest in whatever we want to invest in a 401k, rather than just a handful of whatever the employer was okay with people investing, which I feel like just reinforces the sort of trap that a lot of investors are just in, of like, you think you're doing the right thing by being diversified, but really you then get trapped in funds that are invested in way too many things, way too many securities that you might not ultimately be that comfortable with. So it's a little bit, of a straitjacket. Like, it sounds good, but you're sort of stuck. I don't know. It doesn't, there's been
the
a
Danish
lot of
government have something like that, where, we have this savings account that's great, and then there's a quite high capital gains tax every year on that. But then you can invest in some funds that the Danish government decided, well, these are the funds where you don't have to pay that tax. Right? So they have a list of funds where if you buy these funds, you won't have to pay capital gains on your savings here. But the government decides which those are. It's crazy.
Wow. And of course, there's so many, nuances to what you could do for your retirement investing, and, trying to look out for your future nest egg. And I mean, there's many ways to wealth. At least that's the good news. Like, it's not all, gloom and doom with diversification. But if you are going to be diversified in an index fund or mutual fund, and ETF is similar to an index fund. It's just called exchange traded fund, and it works a little bit differently from a mutual fund, but they're very similar. But just pay attention to things like your expense ratios, how much it costs to actually be invested in that fund. And you want to have it as low as possible. Like, I'm not necessarily endorsing Fidelity's low cost S&P 500 index fund, but that as an example,
throw Vanguard into the mix then, because they are also very low.
Yeah, but as a comparison with Fidelity's, you'll only spend $1.50 for $10,000 invested, compared to the similar one from Vanguard, where you spend $4 for $10,000 invested, or something like that. So the irony is everybody's always like, oh, Vanguard's such low cost, but actually Fidelity has undercut them recently. So it's kind of funny.
I noticed actually that Vanguard was going up the prices, and I was like, John Bogle is here no more. So now they're
maybe Vanguard, I know they're decent too, but you have other options is what I'm trying to say. There are other respectable brokerages out there like Charles Schwab, TD Ameritrade, and some others that you can evaluate and look into and see what fits your needs.
There's so many. Check it out. So Warren Buffett, to quote him, he says, diversification is protection against ignorance. It makes little sense if you know what you're doing. And that's what we're trying to convey here. Know what you're doing, no matter what you invest in. Try to do your best to look into it and don't be ignorant.
For sure. And on that note, it's probably time for us to wrap up today's talk on diversification. And
we hope it was valuable for you, and we will be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.